Your Kirana owner hears the PhonePe ping and pays zero fee, and this April, PhonePe said it crossed 700 million registered accounts with more than 50 million merchants plugged into the same counter habit because NPCI built UPI so bank money could move instantly. So the old promise sounded simple: scan, pay, receive, leave. Before the ban, merchants could face a small MDR on payments. MDR means the shop pays a slice when your payment settles. Then in 2020, India removed that slice from UPI, so the QR stand became part of the furniture. By March this year, UPI carried 22.6 billion transactions, which means this stopped being a feature and became daily retail life. In 2025, value across those rails reached $3.4 trillion, and UPI handled 83% of India's digital payments, so the first consequence was silent. Free had become expected. But every free payment still leaves work behind the screen because banks route it, processors settle it, and NPCI keeps the rail live. So this year's budget put rupees 2,000 crore behind zero-fee UPI, a public check meant to soften the cost for banks and processors, but analysts say it covers about 11% of the running cost, which means most of the bill still has to hide somewhere. PhonePe can hide it because Walmart-backed Scale gives it another counter, where payments lead users toward loans, insurance, and investments afterward. And in FY 2025, that side revenue grew 206%. So PhonePe treats the payment as the doorway to the product shelf, while Google Pay can survive because advertising already pays for attention, but smaller Indian apps do not have that cushion. So engineers keep costly rails running while richer rivals sell nearby products, so users drift toward companies that can lose money longest. By late spring, the companies outside the duopoly stopped whispering as Amazon Pay, WhatsApp Cred, MobiKwik, and SuperMungry asked NPCI for fairer access because their complaint was not that Indians rejected UPI, but that dominant apps could onboard users faster than anyone else, and recurring autopay could lock monthly bills into the same app, which means a free network still had private gates around growth. So officials set the proposed app limit at 30%, but officials extended the deadline twice to avoid breaking daily payments. By March, PhonePe and Google Pay held roughly 80% together, leaving every challenger to fight over the leftover checkout moments, while the government's own BHIM app sat on the same rail, yet stayed under 1% of the market its builders wanted to serve. So the public option existed, but the habit had moved elsewhere, and a shopkeeper finally shows you who pays without noticing. Now watch that Pune Kirana owner close his shutter after dinner. He sees the green tick, hands over detergent, and moves on, and he never pays a payment fee at the counter. But his government still budgets money to keep that counter free, and the biggest apps still earn around the payment, not from it. So the uncomfortable mechanism is this: free access shifted value upward. Indian taxpayers support the rail, while foreign-owned apps own the customer relationship. Walmart benefits through PhonePe, Google benefits through attention and data, while Indian startups face the cost before they reach the products that pay. So the democratic promise stays real for the shopper, but the business outcome tilts toward giants already standing there. Because nobody planned that exact ending when they made payments free. They were solving cash dependence, merchant friction, and digital trust. But tomorrow, when that PhonePe ping lands, ask who wins.